California minimum wage increase for fast food to $22 an hour. What does that tell you about the idea of how persistent these inflationary pressures are going to be?
Well, first, it does tell you they're quite persistent. If one looks at, much of what was driving inflation, it has been, tight labor markets, two openings for every unemployed person. Most recent data has shown that, participation has inched up, but hardly have we seen, large return of individuals to the labor market. So, one, labor markets are tight. Two, as wearing the CEO hat, you're absolutely right to say that in my surveys and conversations with CEOs, they still see quite a bit of pricing pressure in the pipeline. And so they were not in the inflation is peak camp that the market was hoping for. There is some good news, which is the most recent surveys do suggest inflation expectations are still contained over the long period of time, but I think relatively high, slightly above the 2% number. So, I would not argue that one should be at all complacent about that. And you put your finger on exactly the biggest risk that the Fed is concerned about. We may be potentially seeing the beginning of that, or we're certainly seeing how sticky inflation is, even if inflation expectations have not moved. So the Fed has got both problems: sticky inflation that doesn't seem to be coming down closer to 2% at all, and the risk that wage price spirals start to build in with inflation expectations maybe potentially becoming unanchored. So it's a very difficult and challenging time for the Fed right now.
I think one realization for the market yesterday was that the Fed's job is to try and choke the economy to a certain extent without killing it. And yesterday, it got a little more obvious that they're going to have to do that for longer. The odds of a policy error or a Fed miscalculation, some misstep, I don't even know if it's fair to blame it on the Fed as much as to say that the Fed is going to have to squeeze the economy a lot harder, and that could lead to a recession. Where are you in terms of recessionary concerns at this point?
First, Chair Powell himself did talk about pain. He talked about the need to have growth that is noticeably below potential for a long period of time. I think the odds of recession, are very high, and I've said that a few times on the show, and it's for exactly the reason that you've talked about. With inflation being sticky and persistent as it is proving to be, the Fed will have to continue to raise rates aggressively, hold them higher than markets had expected, and frankly, potentially take the economy into a short and hopefully a short and mild recession. But I've said to you several times that I think recession risks are very high at this stage.
Roger, can I just ask you a quick question, because I don't know when we're going to get to see Leisman. How does the CPI take housing cost into effect in terms of measuring rents and in terms of measuring housing prices? Does it work mortgage cost into that, or is that a separate line that doesn't get picked up anywhere?
No, what mainly looks at what is real, and looks at the value of houses, which has been going up but has slowed a little bit, and gets to what's called owner occupied rent or owner equivalent rent. So it's really mainly the valuation of houses. But I think what's driving the house market right now is a big imbalance between supply and demand. And so I don't expect to see that owner equivalent rent or real rent come down very quickly. So I think that's one of the elements that's actually pretty sticky here. Mortgage rates will go up, but it'll take a long time for that to play through.
Now, my only question is, if you're somebody who's sitting in a house with a 3.5% mortgage rate, you may not want to move and trade up to a 6.5% mortgage rate, just because that's going to cost you more on a monthly basis. I don't know if any of that's reflected in those CPI numbers, or if that's just, again, not able to pick up on some of those subtleties.
That subtlety is not reflected in CPI to the best of my knowledge. So I think it's really, what one sees as opposed to the kinds of changes that you're talking about. But part of the challenge here is that rent and owner equivalent rent are relatively sticky. And so, I think even as mortgage rates go up, we're not likely to see dramatic moves in that rent space anytime soon. So that's going to be another one of the Fed's problems, I think.
Roger, thanks. Great to see you.